Good afternoon and welcome to the AICPA Town Hall update on the CARES Act and PPP program. I'm Eric Askerson, one of the AICPA executives overseeing this very important initiative. We greatly appreciate being with you. We've got a fantastic program with a great group of presenters, so I'm going to get right into it. But let me first just cover a couple of quick housekeeping items. You can earn CPE. To earn CPE, just click 75% of the pop-ups, and at the end of this webcast, you can click on that button to get your CPE certificate, and there'll also be a post-event email sent to you. There's a number of capabilities with this platform. You can adjust your volume. One thing we definitely want you to do is to ask questions. We've got a great team here assembled to answer, content questions related to the CARES and PPP Act. And if you're having a technical issue, let us know and we'll try to give you some direction. You can also download today's materials with that orange button. So now let me welcome this great group of presenters. First off, I'm Eric Askerson. I lead CPA.com, the business and technology subsidiary of the AICPA, and we're all about enabling firms, and this is such an important time for us. With me is Mark Koziel, who many of you know, and he's been working nonstop with his team. He leads the firm services area for the AICPA. So welcome, Mark.
Thanks, Eric.
Also with us, we're thrilled to have Administrator Barreto with us. He's a former SBA administrator. He's somebody who's very active with the current leadership there at the SBA and other entities in D.C. We've been fortunate to be in contact with him over the past couple of weeks, so welcome, Administrator Barreto.
Great to be with you. Thank you, Eric.
Also with us is Lisa Simpson, and it's her team who has put together that fantastic resource center, and her team is also the one answering your content questions. So welcome, Lisa.
Thank you, Eric.
And Barry Melanson's with us again this week. And you all know Barry. He's really kind of helping us see through all of this and drive the pace that we need to for the profession. So welcome, Barry.
Thank you, Eric, and thank you for all of the people on the panel and everything that they're doing to really make this program a success and help answer the questions that are out there.
Thanks, Barry. So here's an outline of the agenda, the learning objectives for today. We're going to kick it off with just some broad comments. Then we've outlined the four or five top questions that we're receiving. We're going to dig deep into those. Then we'll share with you the latest SBA and Treasury guidance, share some of our most recent AICPA recommendations, and then we're going to open up to open forum with this group, and we'll close talking about the AICPA's resources and tools. First off, this slide you've seen before, but it's an important slide because this is how we're bringing you all of the information, and this is really how we are helping implement the CARES and PPP Act. We're working very closely with the governmental officials. We're working closely with the coalition we've put together, the information providers, and we're continuing to build a growing relationship with the lending community. First off, I just want, Hector to kind of, Administrator Barreto, provide us some perspective on what he has seen over the first 30 days, and also for him to provide some perspective on this public-private partnership as we execute the implementation of PPP. One thing I just want to note is, where we are right now with the overall PPP program. Over 4 million businesses have now received approved loans through the SBA system, and that's over $500 billion in total funding, and that's occurred over 30 days. So that's quite incredible. Administrator Hector, why don't you please just kind of provide some additional perspective on that?
Sure, Eric. Thank you, and thanks everybody for listening. We appreciate it. I want to talk just a little bit about my tenure. I was the second longest serving SBA administrator in U.S. history. I served better part 2 presidential terms. My tenure was bookended by, at the time, which were the 2 largest disasters in U.S. history. And of course, we all remember 9/11, and at the end of my tenure was Hurricane Katrina. Very different, but there's some similarities as to what's happening right now. 9/11 actually affected the whole U.S. economy, at least for a period of time, and SBA had to stand up new programs that it never had done before, programs outside of its regular economic injury disaster loan portfolio. So we had to be flexible, we had to be creative, and there were a lot of businesses that needed help. And Katrina was different. A lot of more physical damage. Obviously, we don't have physical damage this time, but the volume during that time was unprecedented. We basically got 4 years worth of loans in 1 month, and we ended up doing about 400,000 loans for $10 billion. Eric just talked about the scale of what we're seeing this time around. 10 times more loans already have been done than Katrina, and 50 times more dollars have gone out there. And obviously, this has been able to happen because of the partnership with the private sector, which is very unique. Eric had mentioned, the amount of loans and the amount of money, but one thing that we never had before is the amount of partners. There is over 5,400 banks that are participating in this program. These are the SBA lenders, but they can also be FDIC institutions. They can be credit unions. FinTech is involved, and they keep adding on to this so that they can get to many more people than ever before. So I think when this is all said and done, one of the success stories is going to be the public-private partnerships and how SBA has worked with the private sector to help more businesses than ever before. So it really is incredible. I was on a call with the SBA administrator. She's an old friend of mine, Jovita Carranza. She says when this is all said and done, they're going to do $1 trillion worth of transactions. Many of you know that SBA is a relatively small agency. On a year-to-year basis, they do about 20 billion loans through their banking partners, and during disasters, it can be, again, up to $10 billion if it was a big disaster. This is something very, very different. And I know we're going to get into a lot of other items that are very important to the people on this call, but they're running through the money that on the second tranche, and they're going to run out of money again. It's not going to happen as quickly as the other time because the average size loan now is under $100,000. So a lot more small businesses are getting these loans, and hopefully a lot of that's going to be forgiven if it's used for the purposes that it was intended to. With that, I'll turn back to Eric, and I know we'll have some opportunities to weigh in on some of the other issues that we'll deal with today. Thank you for listening.
Yeah, thanks for those comments, and look forward to more input from you. Related to just the ecosystem's never been more important. In this group here, highlighted on this slide of the SBA-led coalition, they are providing a lot of input. They are working with us on the forgiveness process and the forgiveness calculations. This group represents over 3.5 million small businesses and over 60 million employees. So that input is helping us do many of the things that we're doing related to the recommendations we're providing to the SBA and Treasury. This slide is helpful because it really highlights, what are the major phases and where are we currently at. Where we're at right now is in the forgiveness and compliance phase. With that said, there's still a lot of opportunity for new small businesses to apply. There probably is opportunity for another 1 million+ businesses to apply. So that application process is still important. We are hearing from firms that are working with some clients that just didn't have the data set, developed. It took them a little bit longer. So we're hopeful that more firm clients can get applications in. But what we are thinking a lot about is what's going on with the forgiveness and compliance. There's a lot of fluidity there. There's needed guidance, and I'm going to have Barry talk about that in a second. But there's going to be some overlap between this business relief phase and this next phase, restart and recovery. And we will be talking more about this. I mean, the firms today are playing the trusted advisor role around the business relief area, but that's going to become abundantly important as you move into restart, because you're going to have to think about the business model. As we get business relief, we need to think, the firms are going to be thinking about what is the business model for some of their clients, what needs to be reset, what adjustments do you need to make, what forecasting tools do you want to leverage, what supply chain adjustments you need to make. So lots of questions there that we'll be talking more about in future town halls. But right now, let's dig into clearly one of the top topics, PPP forgiveness, and the discussions with some of the policymakers there, stands, and the need for guidance. So I'll turn this slide over to you.
Thank you, Eric. You know, as all of the participants I think know, as we were going through that phase that Eric just referenced on the application point, and we'll touch base on a couple more points related to that overlap. But as we went through that, we produced a lot of information prior to some of the guidance coming out of Treasury or the SBA, because there was a need in that rapid period of time, which was the intent of the program and of Congress's intent, to get this program out and helping small business very, very quickly. And then ultimately, some of the official guidance came out as it relates to the applications that basically mirrored what we offered as guidance, or actually as recommendations. Where we are today is the need for, and clearly, you know, your questions to us and everybody in the business community, is the need for greater guidance in the forgiveness process, exactly how that will work, so that good advice, that trusted advisor role that Eric just talked about, can be given by our profession to those millions and millions of small businesses that are part of this PPP program. We have been working diligently from that standpoint. We have been providing recommendations. You're gonna see some work from Mark Koziol here related to that, some guidance. There is a lot of bipartisan support for the need for this guidance to come out, and frankly, for the flexibility in the process of getting to forgiveness. And this is a trade-off that I think is a difficult one for the Treasury Department to be focused on right now, because they clearly want to drive, in a relatively short period of time, employment and getting people back off the unemployment rolls, et cetera. They increased another 3 million today. And so, but at the same time, you know, there is this need for guidance. So there is bipartisan congressional support. We asked our grassroots to really make this known to all of the members of Congress, all 435 House members and 100 senators, that this must be driven, because time is ticking since people have been funded and they have to make the right kind of decisions. And so we keep hearing that's imminent. We hope that that comes out very quickly. And frankly, there are some technical points associated with that. For instance, one of the big issues that we have raised is when does the 8-week period start? Now, I have to tell you, there are a lot of groups asking for all sorts of different changes in the forgiveness guidance. We have been focused on those things that we think most closely relate to the intent that Congress had in passing this legislation. So, for instance, our position on the 8-week period is that the start date should not be on funding if you were a shut down business, but rather should be when government gives you the permission to operate. That seems to be a fairer outcome for those types of small businesses. Our belief is that we will get some guidance, whether we get that specific 8-week guidance or not. Some are arguing for 16 weeks and the like. But we think we took the role that we think was the most prudent, because we said to stay in align with the intent was the key. I do believe that once this guidance comes out, that the role for firms in advising their clients on how to get to that, and there will be a role also as it relates to what is the documentation process for banks, will be very critical. And I think it, particularly depending on what that ultimate guidance is, that's made official, there will be sort of some pretty good decisions, some good decision-making processes that you'll have to go through with your clients, or if you work in a company, for the company to make those decisions. So, Eric, I'll give it back to you to go into the matrix point with Mark.
Thanks, Barry, and it's a perfect segue to Mark Koziol to talk a little bit about what we're working on now, this very important loan forgiveness matrix. It's something that we will. I think it's been posted already to the Resource Center, Mark, so I'll let you cover this now. And then Administrator Barreto, I'm going to come back to you just with some questions on where you see guidance currently standing with the SBA. But first to Mark.
Yeah, thanks, Eric. And so we have been focused on the forgiveness now for a little bit. We've made recommendations. We can talk about that later. But really around this matrix, so what is the verification process going to look like at the back end? As we've been talking to some firms who have strong relationships with their community banks may have already been asked by the community bank to assist in the kind of back office verification. And again, absent guidance, we don't know what that verification is going to look like, what's going to be required of the bank or the company itself as proof that they actually spent it the way that it was supposed to be spent. But we put together this matrix to try and help answer some of these, and we plan on communicating that also in DC, because who better than the CPA community to help with that verification? And some of the ideas are, we've been in the single audit business helping with federally funded programs for a long period of time, adding programmatic audits that we can send into the GAO and the federal government as we do the financial statement audit of not-for-profits. So why not the same thing here, provide some level of verification. So for the firms, though, if you don't plan on doing any type of, agreed upon procedure at the back end, we broke down based on the different engagements that you may have. If you do client accounting for the client, what are your options? If you do tax for your client, what are your options? If you provide some level of a test, what are your options? And so we talk about providing advisory services, and we talk about providing agreed upon procedure reports. But agreed upon procedure reports, if you're not in the audit business today, that it may not be an option for you because of peer review requirements under AUPs, similar to the other attestations. So we wanted to break that down. You have here on the slide is the actual link to the matrix that lives on our website. And so you can kind of go through that and figure out where you want to play, how are you interacting with your client. And then on the back end of doing AUP, whether you're engaged by the bank or by the client to do it, what your options are there. We have sample engagement letters and then sample reports on the back end for AUPs to try and help our member firms through this process. Eric?
Yeah, so Mark, you want to clear this slide, and then I'm going to go to Administrator Barreto to see where he thinks some of this guidance is with SBA.
Yeah, and I had mentioned that before. Thanks for that. We did provide recommendations. We provided them to SBA, to Treasury, absent other guidance. We're saying we need that guidance, but we would also like that guidance to include some of these things. So as you look at this, though, item 1, 3, and 4, I would call procedural advice or procedural recommendations that we're making. And the second one being that advocacy piece that Barry talked about is having flexibility around the 8-week period. So, the first, we covered this in last week's, but a very high overview, and we have more information on our website. You can click, again, the link here to see how we're communicating this. Number one is, start the covered period, start the 8-week payroll period, either in the start of a pay period immediately preceding or immediately after when the funds were dispersed. And then the third item being full-time equivalents. We provide recommendations absent tracking hours in an organization or absent having just full-time employees, making recommendations around how to calculate the FTEs. And the important thing really is consistency in the coverage period and the comparative period to make sure that we're looking at apples to apples. And then the last item being, one of the calculations we have to do is by each individual employee, their compensation has to be at least 75% of what it was in the prior quarter. But many of you have raised the question to us, well, if I compare quarter to coverage period, the quarter is 13 weeks, the coverage period is 8, I'm automatically going to be disallowing all these employees if I'm looking at the totals from each. And we recommended doing an average payroll per pay period by employee to figure out what it was in that 13-week period versus what it is in the 8-week period. It just seems to be around the intent of what they're looking for. Again, absent guidance, these are recommendations. We have talked to the payroll companies about them, but we are looking for more support. And I'll turn it over to Hector as far as guidance and what you're hearing on guidance and recommendations.
Sure. Thank you, Mark and Barry and Eric. And I just really want to reinforce the comments that have already been made. This is still a work in progress, if you will. We've had an opportunity to be in regular communication with senior SBA officials. They know what the issues are, and they're working with Treasury to come out with something, and hopefully sooner, or as soon as possible, I should say. They like to say they're not changing the guidance, they're enhancing the guidance. And they've heard loud and clear that many businesses are concerned because through no fault of their own, they're not able to bring everybody back, or they're not able to start the clock at the same time that they thought they were going to be able to. So they're really looking for some flexibility there. I was on a call with the SBA administrator about a week ago. This issue came up, and she confirmed that she's working with Treasury on this. This really is a joint effort between the SBA and Treasury. Remember, PPP is a new program. It's not something the SBA has ever done before. And I know we're going to get into some of the intent for why this program stood up, but they really felt that this was the fastest way to get money to the people that needed it, and obviously with a tremendous focus on the payroll part of it. By the way, we have also had these conversations with the White House, so not just with the agencies, but letting the White House know, and the White House business team and their policy team and their Leg Affairs team know that this is something that a lot of businesses are looking for, and a lot of trusted advisors like the AICPA really need to better advise their clients and their customers, and really make this a win-win situation. And businesses kind of run the gamut. Some businesses are like, look, I really need this to be completely forgiven. That's why I applied for it. Others are saying, look, I'm gonna, if this converts to a loan, I'm gonna deal with it as a loan. So it depends, but I just want to let you know that the players that need to know about the recommendation. By the way, AICPA has been very helpful in being able to provide these influential decision makers with a really common sense roadmap on what would provide the appropriate fix. I would also tell you that elected officials, and I think Barry had mentioned this before, they're very much being informed and lobbied on these issues. I know that Senator Marco Rubio, somebody that I've worked with in the past, and of course he's the chair of the Senate Small Business Committee, he's aware of these issues and he's pushing for this. And by the way, I don't think it's a bad idea for anybody that's on this call that has a relationship with one of the elected officials in jurisdiction, i.e. the Senate Small Business Committee or the House Small Business Committee or the Banking Committee, to shoot an email or a letter. I know AICPA is really on the front lines of this, but these decisions have not been made yet, and so I think there's still an opportunity to make sure that we end up on the right place of this guidance to help as many of our clients and small businesses as possible navigate through this very challenging, difficult situation. So with that, I'll get back to Eric.
Well said. Barry, I don't know if there's anything you want to add to that regarding just the reach out that we've done. You did mention that we sent the communication out to the state societies to get all of these recommendations out through our grassroots efforts. Is there anything you want to add before I move on?
Yeah. It's not too often that we actually go through that process, Eric, that we ask everybody in the grassroots to make the contacts and to just really deliver a pretty simple message that the guidance is needed. And our membership response to that has been fantastic, and it's a critical component of getting things done in these types of times. It's not that people, as Hector said, it's not that people aren't aware or they're not wanting to be responsive. They are. They are just, there's just a lot of things on their plate, and it's the best intentions, and this is about rising things to the right level of priority that has to be done for the economy at any particular time.
Thanks, Barry. So with that, we'll move on to something that we're all very familiar with, is the media. The media is out there, scrutiny on everything that's going on. And it started in early April. It was all about implementation issues and confusion, issues with the platform. And over the past 2 weeks, we've all seen how this moved to who is receiving funds, the Ruth Chris's, the Shake Shacks, the LA Lakers. We talked about that last week. And what is going to start happening is that there's going to be, just this week it was announced that there were some fictitious applicants, and we know that's going to occur. There's fictitious applicants, and we know also that firms are going to play a role around the forgiveness process, and the SBA is going to be doing things as well as the banks to kind of be vetting these applications to stop, fraud. But what all of this has done, in particular around who is receiving the funds, is that it has put more pressure on Treasury, and Treasury responded with FAQs 31, 37, and 43. And those were about the large companies, public companies at first, applying for these loans, and they came out with a liquidity statement, and then FAQ 37 related it to the private companies. And what we feel, and others feel, and Barry's going to talk about this, has happened is the pendulum has gone too far. So Barry, I'll turn this over to you. I know you worked hard. You were active in that blog that was put out under your name, and we'll be covering this over the next couple of slides.
Yes, thank you, Eric. Obviously, this is of some major significance as you work with your employer or your clients and trying to decide whether or not in response to these questions that you should be part of this group that might be considering paying back the funds in a sort of a safe harbor way. And we think that is something that we have to go back to the intent. And I think that I've been very vocal on that, and I believe that this is about intent, and this is a focused effort to make sure that the critical component of our economy, known as small business, is healthy enough to help bring our economy back. Congress has spoken very loudly on that. I think this program, as it was set up, and actually a lot of the decisions on the application process as how it was set up, was related to that issue. We communicated very directly to Treasury when they were setting this program up, saying, if you want it done fast, it has to be a very easy, simple application process with not a lot of requirements. It won't be perfect if you do that, but that will help us get the money into the economy, into the small businesses' hands as quickly as possible. And as Hector said at the beginning of this seminar, that has pretty much been done. And I think that the massiveness of this has been achieved. And now, as we see a few incidences that become high profile, it's very important that we do not let the pendulum swing too far. And yes, there are questions out there that use the term a definition of liquidity or sufficient liquidity. I would just remind all of you that the application process that was brought forward was for predominantly the entrepreneur, the business owner, the senior manager, if you will, of that small business, to indicate whether or not the economy has an impact on their business. I think, and actually Hector sort of used this term a few minutes ago, everybody has been impacted. It's very hard to not see a small business impacted today. I'm sure there are some examples, but there are not massive examples of not being impacted in this environment. And also, it is not over. Just because governments are starting to start the economy back up, the road for recovery and survivability for small business is very uncertain. Small business is a critical component of our economy. It is important for big business to survive today too, but if we're going to have a healthy economy quickly, a relatively quick recovery, we are a consumption-based economy. Our economy not only fuels our economy, our small business world not only fuels our economy, but it fuels the global economy. And all of those things are interdependent. And a healthy small business is important. The intent of Congress was not to cause these small businesses who have been impacted to now be thinking about paying back these loans. That is not the case. And liquidity, we're getting a lot of questions for our members. Well, we need a definition to a liquidity. I believe, and I don't know this for sure, but this is my belief, that the reason why it was worded the way it is to create the ability for people to use judgment in this process. You do not want a formula, because the best, if I took 10 of you off of this seminar, the 10 smartest of you, and we sat down and said, let's define liquidity for small business in this criteria, it would be virtually impossible. But what would be absolute is whatever definition we come up with, it in fact would exclude a lot of businesses, small businesses that have been impacted. The concept here is, have you been impacted? And I think we need to be advisors and we need to think through this without the certainty of definitions, and we need to not let that pendulum swing too far. From my blog, you see the quote on the slide that says the worst thing would be for small businesses to be paying back these funds and then choosing to lay off, significant numbers of people. That is not what this economy can sustain. It's not what we want from this process. It's not what the government and the Senate and the House wanted. And if you go to the next slide.
I have a slide for you just on very similar to your blog, which came out yesterday
right.
from congressional leaders sending it off to the SBA.
Right. This is a screenshot signed by 2 members of Congress that uses almost the exact same words I just shared with you. It's broken down in the print here. And it points out small businesses with some excess liquidity still must decide between keeping employees on payroll and using that liquidity for operating costs. And that is what we must fight against the notion that this was wrong. You see that highlighted. This is plainly wrong. It was not Congress's intent for PPP. And so we as a profession are in the ears, the advisors to these small businesses. And for those of you who have heard me speak on this, we have medical professionals on the front line getting us from a health perspective through this terrible situation. Now we are starting to shift to how does our economy return to a healthy situation. And we're the professionals that most impact that, specifically most impact that from small business. And so it really requires us to be able to have the courage to be able to use judgment in this process. It is unlikely we're going to get definitive answers to these questions. And as I said, definitive answers is the old adage, be careful what you ask for. Definitive answers will just inevitably exclude some businesses that have been impacted and therefore start to impact employment and the like. And so I would ask all of you to think about going back to that intent. What are we trying to do? We're trying to set up a program that the predominant amount of the money will be forgiven when it's paid on payroll, and that leads to a good chance for those small businesses to survive and hopefully thrive as the economy starts to recover.
Barry, excellent. And I can tell you we've got a lot of comments coming in. People appreciate this. There's questions about where can they find the blog. The link here in this presentation will take you to the blog. You can go to go to the homepage, go to our SBA Resource Center. That will take you to the blog. So lots of ways to get that information. I'm going to have you, Barry, just, we talked about this a month ago on our video, the self-assessment of needs. This is just keeping the pendulum in the middle, and then I'm going to have Administrator Barreto just comment on how, he sees the intent as well. But I'll let you cover some of this slide first.
Yeah, look, this is in the public domain. It will be in the public domain. I would say that businesses have gone through, good faith assessments. My advice to whether they are manufacturing enterprises or retail or restaurants or professional services firms, whatever, in the marketplace, it will be public. And there will be people who second guess. And you know what? It may move off the headlines for some period of time, and it'll probably come back again in a year or 18 months. It is inevitable that these things happen. But we cannot lose that focus on what the intent is. And with that in mind, we should be documenting. We know how to do this as a profession. We should be documenting what the thought processes are in a contemporaneous way. What was happening when that entrepreneur signed that form? The uncertainty they had, the uncertainty about the collection of receivables, the desire to avoid laying off people, the capabilities that, future sales might evaporate, and what that, problem creates for a small business. Even ultimately government closure edicts and the like. And so we should be documenting those things. And it also, I've had many conversations with leads and CPA firms where, in good faith, companies have said, I'm a manufacturer and I think I'm going to lose, X number of my clients, and I would lay people off, but I'm not because of the existence of PPP. That was the intent of the program. And then, a month later, maybe they've shifted. I heard a story with a manufacturer who shifted what they manufacture. And they are now producing totally different things with a new customer base and doing okay. Well, it doesn't change the fact that when the PPP loan was obtained, and that's maybe this month why they retooled, they needed to keep, people on board from that standpoint. And so this is about us being the advisors, understanding where the risk management perspective is for the client, both from the potential public relations risk, but also what their business risks were. Document that, and that really is what I think the government is expecting you to do right now. And they're really not expecting that pendulum to shift in a way that is going to cause people to send back the money and lay off people the next day. That is not the intent of this program. And I would be interested with Hector's observations on that, because obviously he sat in the inside of those rooms for many, many years.
Yeah, thank you, Barry and Eric. And I think it was very well said, Barry, and I agree wholeheartedly with your comments. I'm remembering back to some of the disasters that I was involved with. In 9/11, we got criticized because we were helping businesses outside of the disaster area, even though there was a tremendous amount of pressure on us to be able to do that. And we did that with loans through the banks. It wasn't the PPP program, because this is something totally different. But I got a lot of criticism after the fact. People have sometimes selective memories. I remember during Katrina, the criticism was, they don't want loans, they want grants, just give them grants. But we had no authority to do grants, so we got a lot of criticism. And this happens during every disaster. But to your point, Barry, the idea was to provide businesses with as many tools as possible. And PPP was a very important tool, kind of a bridge, if you will. It's not the panacea, and obviously it doesn't help small businesses and everything that they need. And then, of course, you had the regular disaster loan that a lot of people applied for. You have regular SBA loans that people are going to go for as well. And there's nothing that prevents people from utilizing more than one tool. Of course, this time around, there's also some small grants and some tax credits. So it's all of the above. But I think Eric said that when this is all said and done, SBA could have done, again, with their lending partners and what they're doing themselves, 5 million loans. That's more than half of companies in the United States that have employees, because as you very well know, many smaller companies don't even have employees. Also, your average loan size now is down to $79,000. So these examples where, a company that, again, is not normally participating in SBA programs got access to a loan because of how the program was set up, and that's going to be the exception to the rule. But I think that, again, the things that Barry was saying was around reminding folks of what the situation was when that business took the loan, and make sure that everything was submitted properly. In other words, people didn't make up stuff. I think it's going to be very critical. And remember also that while people were applying for the loans, the kind of surveys that we were getting was that 25% of all businesses said that they had 60 days to live. In other words, if they didn't get loans, these PPP loans, or be able to conduct normal operations, they wouldn't make it. So there was a tremendous amount of panic, and one of the reasons why government moved as quick as it did. Government doesn't normally move this quick, and they were able to stand up this program in less than a week. And I've already funded it a second time, and probably going to have to come back and fund it again. So you have to kind of remember all those things collectively, because 6 months from now, people may have forgotten. And the real focus is going to be, so to speak, on these what they consider egregious examples. The Lakers, or a private university, or a major restaurant or hotel chain. And even then, the affiliation rules were relaxed to allow them to participate. Some of those folks have decided that they actually didn't need the money. But again, I think those are going to be the exceptions rather than the rules, and I think the work that you're doing with your clients, helping them understand these issues, is critically important. And the purpose of the program was what it's being used for right now in the overwhelming amount of cases. So with that, I'll turn it back to Eric.
Well, thanks. I think we've covered this. We'll post this, maybe a special section of this recording on our site, because this is probably the top question coming in right now. But let's now move to a couple of other items. I'm going to ask Mark to quickly cover some of the guidance and first just hit on this loan deductibility issue. Mark?
Yeah, so many of you have seen that IRS came out with a ruling that the expenses that are covered by the PPP loan are not deductible. I don't think that story is over. And I realize that your clients may be calling you to say, okay, now what? Should I or shouldn't I? We are still of the opinion that PPP is a good program for small business. We are not done talking about trying to get that reversed. In the act itself, it did state that the income, the PPP loan that you got forgiven would not be taxable. But if you tax or don't allow for the expense to be deductible, in essence, it's like de facto taxation on the income. So we're going to continue to that. This is not an answer you need today. But we're going to continue on with that and hope for the best. I mean, bottom line is, many businesses are probably still going to be in a loss for this year anyway, so the deductibility won't be as big of an issue, but it'd be awfully nice to be able to deduct those expenses. Eric, if we go on to the next, we'll just talk quickly
thing, Mark,
about
there's a lot of bipartisan support. I mean, so it seems, I know you don't want to make a prediction here on the call, but it seems like there's a lot of support to make that happen, but we'll continue to watch that.
But Eric, bipartisan support, and again, it goes to the intent of helping small business, because if you allow the deductibility, and even if it's a benefit into the future with an NOL carry forward, that is an important way of supporting small business, which is so critical to the economy. And the fact that bipartisan support, as was shown on that previous slide, is really saying that to Treasury and even potentially offering legislation to clarify that, I think you have to look at it from that standpoint. Again, this is another form of support for that critical small business component.
Thanks, Barry. Mark?
Yep. So if we move on to some of the guidance that's out there, there's two quick hits. You're going to see guidance flying left and right around this. Our team, Eric had mentioned how hard they're working. Lisa Simpson, we have here answering questions, are in the back room right now, looking at all those questions as we come through, and they're looking at the guidance. I mean, literally, as it hits the street, they've been on top of this to be able to see it. So the first area that we see are some final rules that have come out, neither one of which are really going to apply to many of the clients that you have. The first one talking about corporate groups versus affiliation rules. Very few companies are going to be affected by that. And then non-discrimination, additional eligibility criteria, nothing earth-shattering in there other than student workers can count towards eligibility. So I'm not going to spend a lot of time on that. The next one being additional FAQs that came out right up until May 6th or 7th. I think it came out last night, if not this morning, about extending the safe harbor deadline to May 14th. We've already spent enough time to say, that they were through the questions 27, 31, trying to define what a company should do if they didn't meet the criteria of economic uncertainty. There'd be a safe harbor to give the money back by May 7th. They've now extended that to May 14th. So we do hope for additional guidance as far as creating what the calculations are. Don't think we're going to get it on what that economic uncertainty looks like, but encourage you to document everything. Also with that, based on the way the language was written, there were many who felt that if someone applied for the loan, received the funds, but gave back the funds, that they were no longer eligible for the employee retention credit. They have since cleaned that up. as part of it as well. So you see here on the slide some of the other pieces that were talked about, reducing the loan amount of an employee that we offered to rehire, but then they turned it down. There's guidance on that. Some items about not-for-profit hospitals, seasonal workers. Nothing, again, earth-shattering, not the most pressing issues that we were hoping to get guidance on other than the ERC, so encouraging those. But there's so few businesses that either should be or would be returning the funds that, you may have a couple of clients, but it is something to look at as you're analyzing whether or not the company is thinking about giving back the money, what the other options are that are out there. With that, Eric, I'll turn it back over to you.
Yeah, thanks, Mark. Everybody's staying busy, to say the least. So just a quick update on the lender activities. You heard that there's 5,400, lenders participating in this program. We continue to work with the lending leadership and to make sure that there's a positive relationship. We issued a statement with the ABA around the firm-lender relationship and the payment of the agent fee. If you are having issues, let us know. There is a lot of value seen in the banking community for the role the firms are playing, and as Mark discussed earlier, the whole forgiveness process is going to continue to give us that opportunity for the firms to work closely with the banks to complete the execution of in essence, this grant. So Lisa, I know you're out there looking at the patterns of questions. Lots of questions are coming in. So let's get ready to address some of those. We, just on this slide here, this slide shows all the different relief options that we've been discussing. We've been focusing a lot today on PPP. Last week we focused on employee retention credit. Mark talked about a couple of these elements just a moment ago. There was a new announcement that just came out an hour or so ago around the EIDL. Administrator Brett Otis asked you to comment on that. You've got a lot of experience with that program.
Yeah, they didn't know what the demand was going to be. It was huge for the regular disaster loan program. And what you're seeing now is that they're basically capping the total amount, regardless of liabilities, up to $150,000. I also think that the uptake on new applications is being affected, and they also have gotten a little bit of pressure to really focus in on more agricultural farm type of companies. So as part of this is that, they got another $60 billion in the last package, but based on the volume that they're seeing, they're really trying to kind of, target that a little bit more. And, I know we're going to talk about this in a minute, but I think there could be another package to replenish that. So that's what we're seeing. There's a story just came out today. I think it was in the Washington Post talking about that. And a little bit of a surprise on that because there wasn't really an advance warning. I said this at the very beginning, usually the disasters that SBA deals with, because they're the disaster bank for the federal government, deals around physical damage, which you can kind of get your arms around about how many people were affected, how many businesses were affected, what the total damage is going to be. This is really, they're flying blind. And, this is affecting every business, and, they're trying to get as much money into the right hands as possible. But I think you're going to see the EIDL program a little bit more limited for the next couple of weeks until they get some additional resources into that program.
Thanks. So let's just go to that. There is discussions already about, CARES 2.0 Phase 4, potentially could be up as large as $2 trillion. I don't think we're going to talk more about that today. Here's a slide of some of the potential elements. Barry, I'll just a quick comment from you, then we're going to go to Lisa to take some questions.
Yeah, I mean, look, this is a political process, so there's nothing certain there. There are liability is a major concern that businesses have as they start back up. There are some red lines being drawn on both sides of the political spectrum about what has to be in or what under no condition will be in, and that makes passage probably less certain than some of the quick action that Hector referenced before. I think, and even Congress coming back and how quickly they can get to it. So I wouldn't, there's probably a reasonable chance something passes, but it's not certain, and it certainly won't be quick.
So Lisa, thanks, Barry. What are some of the top questions that we could address?
Thanks, Eric. One of the questions we've been getting is around the accounting for PPP loans and subsequent forgiveness of those loans. Mark, I don't know if you want to talk about that, or I can.
The accounting for it, I can do.
Okay, that's fine.
There is some guidance that's being published on that. We're working on that. There's different ways of doing it. For the most part, if it's and I think the guidance will provide some flexibility. It's probably particularly important in a franchising situation where there's certain financial results, balance sheet items that need to be met in order to preserve franchising relationships and the like. But our technical team is going to be publishing something, and there's 3 or 4 different ways of looking at it. For most businesses, most small businesses that get forgiven, it's not until an end of the year issue, unless they have a really significant financial reporting requirement on a quarterly basis. There is some potential grant accounting options that some people may want to take advantage of. So we are going to issue a document that shows those different options and talks about how you might think about applying.
Thank you, Barry. We've also gotten several questions about where to find the blog that Barry talked about earlier, and also where to find the Treasury FAQs. Just as a reminder, we have links to all of those on the SBA resource page on our site. It's aicpa.org/SBA, and we'll have a slide later in the presentation that can give you the link there. We've also got some questions about if a borrower accidentally borrowed too much because they included payroll taxes or employer portion of payroll taxes in their payroll costs. Do they hold on to those funds until the forgiveness or until the 8 weeks is over and then give it back? Should they give it back before the May 14th safe harbor? Any thoughts on that?
So there's another safe harbor. This is my opinion. Barry, love to hear it because I'm sure I'm completely wrong, but we'll try it. It was an estimate. And based on the facts that we knew at the time, there were many people who applied, and the average monthly payroll was not defined. And so in the FAQs currently, there is a safe harbor that you made the calculation based on information you knew at that time. I don't believe that the safe harbor saying we have to give money back by the 14th or the 7th, is going to be the factor that we have to follow for this one. At the end of the day, it was an estimate. When we get to the end, figuring out how much we actually have as forgivable, and then how much can either be converted into a loan or can be given back. There is no penalty for giving back early. So if they believe that they know that number now, give it back now. If not, it can wait. I don't know if others have any ideas on that.
On that, it's both ways, too. Some people, they based on in the information, their loan calculation was too low in some cases, and in some cases, based on what they thought the available information was, and based on that, it came out higher than it will as part of the forgiveness process. So I think on both those cases, the safe harbor, and at the end, they'll either have an easier time if it's less, and then getting forgiveness on the grant, forgiveness on the loan, or if it's a little bit higher, it'll convert to a loan, or they'll have to pay it back.
Agreed. Can family members be hired to count toward the payroll costs in the 8-week covered period?
Mark?
Sounds like that's a fairly loaded question. So, I do not see guidance that if an employee does not return, that we cannot rehire for that position is the best way that I can answer it. I don't know if others have opinions, but if someone doesn't return, there is the option of hiring a new employee to work within that role.
Yeah.
And these are things you can talk to the lender about, but there is that if you cannot hire the employee, one of the FAQs came out and stated that you can still get forgiveness and offering that position to a potential new employee, which in some cases, could I guess be some related family member.
I think it would be important to apply thinking in that process that would be reasonable. In other words, that the work is actually being done and the wages are fair market value, arm's length to the extent as possible, and that the work is actually being done. And I would go through that process of documenting that.
We have a lot of questions that are very detailed about the forgiveness process, and it's what does paid and incurred mean? How do you calculate payroll if you've got a monthly payroll or a semi-monthly payroll? How do you calculate FTEs? So there are just a lot of areas where we are continuing to wait for the guidance. We've gotten questions about when the AICPA's forgiveness calculator will be released, and I just want to reiterate, we have published a document that is a high-level overview of the steps included in the forgiveness process. However, with the lack of guidance that's been issued to date on forgiveness, we're just going to wait and release the calculator once some of the details are released by the SBA. There was a question, a clarifying question. So, Eric, I just want to throw this back out to the group really quickly, and then we can make this one be the last. If you did not get your question answered, you can email pcps@aicpa.org, and we will do our best to respond. There was a comment that they wanted to clarify one thing they thought they'd heard. If a company receives a PPP loan, are all of the company's shareholders going to be named?
Lisa,
I don't know that. Go ahead, Eric.
I think that it's in the application. When you say, I think there's a percentage of ownership, so that's something. Why don't we just take that offline? I think that's when you say all the shareholders. I think there is a percentage of ownership, but we can get confirmation on that.
But the basic rule, right? The basic rule is that the application would be ultimately subject to Freedom of Information Act information, not company financial information if it was submitted, but the application would generally be FOIA-able. Freedom of Information Act.
Yeah.
Thanks, Lisa, and thanks to your team for answering all the questions online and for building that resource center. So, Hector, we only have about 2 minutes, but I wanted to give you one quick closing remark related to just broad perspective on this recovery based on your past experiences, and then I'm going to just share some closing slides.
Yeah, we're seeing, surveys coming back out where a lot of businesses have already applied for the relief, and that's really going to help them navigate it. They're being as optimistic as they can. Having said that, there's a lot of small businesses that are not going to, qualify for the program. They're not going to get in time, and they're really going to have some tough time. We're going to lose some small business, some of the smaller ones, but it can be some of the mid-sized companies as well. And we saw this during the other disasters. Those companies that are planning, that are, reaching out, getting access to tools, talking to advisors, those are the companies that usually survive. And those companies that are kind of lost and still kind of in a state of shock, unfortunately, many of those companies don't come back. So we're going to have to monitor it, but I think there's been a lot of relief funds that have been provided, and I think that's going to be very, very helpful to get the economy going again. It's not going to go back to normal immediately, but I think, as we get to the end of the year, I think we're going to be, very glad that we did the programs that we did at the beginning of this pandemic.
Thank you so much, and just great closing remarks there. I mean, the firms here, as we were talking at the start of this webinar, need to support their clients in the restart. The business relief is the bridge, and then the restart's going to occur. So thanks, Administrator Barreto, for your participation today and also just for your support over the past month. Barry, Mark, and Lisa, thank you as well. A lot of positive comments coming in from all the attendees. Here's another resource center we have more dedicated to tax issues and the different relief bills. Next steps here. This is such an important time for all of us. It's a defining time. So thank you for your hour today. Hopefully this was helpful. We're going to continue to provide these updates. The next town hall will be next Thursday, 3 p.m. You saw today we brought the most current information to you. We'll try to do that again next week. We also have another webcast on May 13th that's going to be about deciphering FFR, FFCRA, and CARES. You can find out information on our via this link or on our resource center as well. So thank you for today. Thanks for your time. I hope you're all well and safe, and we look forward to staying in touch. That's all for now. Thanks. Bye.